1. Financial restructuring. Goal: change the capital structure mix so that the firm can meet its obligations and fund growth. Analogy: think of a family that has a $200,000 mortgage debt and a $50,000 credit card balance high-interest debt. By refinancing the mortgage to a lower rate and converting part of the credit card debt into a small ownership stake for a relative, the family reduces monthly payments and improves cash flow. Key tools: debt rate profiling, extend maturities, lower the interest rate, or introduce a grace period. Example: a company has a $100 million 5-year loan at 8% annual interest, $8 million. Negotiation yields a 7-year term at 6% with a 2-year interest-only period. New annual interest equals $6 million, and cash outlay is spread over 7 years, reducing yearly principal repayment from $20 million to $13.7 million. Equity recapitalization: issue new shares or convert debt to equity. Suppose a $30 million senior note holders agree to swap for 2 million new shares at $15 per share. The firm's equity rises by $30 million. Debt falls by $30 million, improving the debt-to-equity ratio. Valuation: two common methods are adjusted present value, APV, and discounted cash flow, DCF. APV: value of the firm equals present value of unlevered cash flows plus present value of tax shield. Unlevered free cash flow equals $25 million per year for the next 5 years. Discount rate 10%. Present value of UFCF equals sum from T equals 1 to 5 of 25 divided by 1.1 to the T, which equals $92.3 million. Tax shield equals interest times tax rate. After rate profiling, interest equals $6 million, tax rate 30%, resulting in annual shield of $1.8 million. Present value of shield discounted at 10% equals sum from T equals 1 to 7 of 1.8 divided by 1.1 to the T, which equals $10.6 million. APV equals $102.9 million. DCF levered uses weighted average cost of capital. New capital structure: debt $70 million, equity $80 million, debt-to-equity ratio 0.875. Cost of debt 6% after rate profiling, cost of equity 12% from CAPM. WACC equals 70 divided by 150 times 0.06 times 1 minus 30% plus 80 divided by 150 times 0.12, which equals 0.058 plus 0.064 equals 11.2%. Discounted cash flow equals sum from T equals 1 to 5 of 25 divided by 1.112 to the T, which equals $87.9 million. Leverage ratio impact: before restructuring, debt $100 million, equity $50 million, debt-to-equity ratio 2.0. After, debt $70 million, equity $80 million, debt-to-equity ratio 0.875, a healthier balance that eases covenant compliance and reduces bankruptcy risk. Takeaway: by stretching debt, swapping a portion for equity, and revaluing the firm with APV and DCF, the company improves cash flow coverage, reduces financial risk, and creates value for both creditors and shareholders. 2. Operational turnaround. Goal: cut costs, improve efficiency, and align capacity with demand. Imagine a restaurant that spends too much on ingredients because it cooks large batches regardless of how many customers show up. By preparing food only when orders arrive, just in time, and measuring the cost of each dish, the restaurant saves money and reduces waste. Cost reduction frameworks. Zero-based budgeting, abbreviated ZBB: every expense must be justified from scratch each year. Example: a division with a $40 million operating budget breaks it down line by line. After questioning each item, it finds $5 million can be cut, for example travel or redundant software licenses. 6 Sigma/Lean: identify process variation and eliminate waste, called MUTA. If a manufacturing line has a defect rate of 4%, that is 400 defects per 10,000 units, and the cost per defect is $50, the annual loss equals 400 times $50, which is $20,000. A 6 Sigma project reduces defects to 0.5%. Loss falls to $2,500, saving $17,500. Activity-based costing, abbreviated ABC. Allocate overhead based on drivers such as machine hours or number of setups. Suppose overhead equals $30 million and two products, A and B, use 1,000 and 3,000 machine hours respectively, total 4,000 hours. Overhead per hour equals $30 million divided by 4,000, which is $7,500. Product to cost equals 1,000 times $7,500, which is $7.5 million. Product B cost equals 3,000 times $7,500, which is $22.5 million. If product A's selling price is $12 million, its contribution margin improves when the true cost is known, guiding pricing or discontinuation decisions. Break-even analysis. Formula Q sub B equals fixed costs divided by the difference between price per unit and variable cost per unit. Example, fixed costs equal $15 million, price equals $25, variable cost equals $15, so Q sub B equals 15 divided by 10, which is 1.5 million units. Capacity utilization. The plant can produce 3 million units per year. Current output is 2 million units, utilization is 66.7%. To improve, the firm can either push sales, increasing volume, or downsize, reducing fixed cost. If it cuts fixed cost to $12 million by closing a 30% idle line, new break-even equals 12 divided by 10, which is 1.2 million units, giving a larger safety margin. Takeaway: using ZBB, a BC, and break-even or capacity analysis turns vague cut cost slogans into measurable actions. Each dollar saved is tied to a specific activity or inefficiency. 3. Strategic repositioning and portfolio refocus. Goal: move the firm toward higher growth, higher margin businesses and exit low-performing ones. Analogy: a farmer has a 100-acre plot, 60 acres grow wheat low margin, and 40 acres grow specialty berries high margin. By selling part of the wheat field and expanding berries, overall farm profitability rises. BCG growth share matrix. Axes: market growth rate, vertical and relative market share, horizontal 4 cells. Stars: high growth, high share, invest to keep leadership. Cash cows: low growth, high share, harvest profits. Question marks: high growth, low share, decide to invest or divest. Dogs: low growth, low share, consider divestiture. Example: company with 4 units. Unit X 20% market growth, 1.5 times share star. Unit Y 3% growth, 3 times share cash cow. Unit Z 18% growth, 0.4 times share question mark. Unit W 1% growth, 0.3 times share dog. Strategic choice: allocate 30 million to X, grow 5 million to Z, test, harvest cash from Y and sell W. GE McKinsey matrix: more nuanced, uses industry attractiveness, size, profitability, growth and business strength, market share, brand, cost, position. Each axis is scored 1 to 5, cells guide investment levels. A unit scoring 4 out of 5 on both gets heavy investment, 2 out of 2 gets selective growth, 1 out of 1 suggests divestiture. Divestiture spin-off valuation. Discounted cash flow method: estimate the unit's free cash flow and discount at the unit-specific weighted average cost of capital. Assume unit W generates 5 million free cash flow per year. For the next 5 years, terminal growth 2%, weighted average cost of capital 10%. Present value of free cash flow equals the sum from T equals 1 to 5 of 5 divided by 1.1 to the power T equals 18.9 million. Terminal value equals 5 times 1.02 divided by 0.10 minus 0.02 equals 63.75 million. Discounted equals 39.6 million. Enterprise value 58.5 million, subtract net debt 8 million equals equity value 50.5 million. Real options assessment: treat the divestiture as a call option to sell later if market conditions improve. Option value: black skulls equals C equals S n of D1 minus K e to the minus RT times n of D2. Let current estimated sale price S equal 55 million, exercise price K equal 50 million, volatility sigma 30%, T equals 1 year, R equals 5%. Compute D1 equals open parenthesis natural log of S over K close parenthesis plus open parenthesis R plus sigma squared over 2 close parenthesis times T divided by sigma times square root of T, approximately 0.68. D2 equals D1 minus sigma times square root of t, approximately 0.38. N of D1 equals 0.75, N of D2 equals 0.65 c, approximately 55 times 0.75, minus 50 times e to the minus 0.05 times 0.65, approximately 41.25 minus 30.77 equals 10.48 million. The optionality adds 10 million to the decision, showing the strategic advantage of keeping the option open. Takeaway: by mapping each business on BCG and GE McKinsey, the firm can decide where to invest. Harvest or exit valuation discounted cash flow gives a baseline price, while real options quantify the value of flexibility critical in uncertain turnaround environments. Goal: align interests of owners, creditors, and managers, while navigating legal routes to restructure or liquidate. Chapter 11: United States Reorganization. The company stays alive, proposes a plan of reorganization to repay creditors over time. Automatic stay protects the firm from lawsuits. Creditor committee, usually the top 5 unsecured creditors, negotiates the plan. Example: a firm with 120 million debt proposes to pay 70% cash in kind over 5 years and convert 10% of senior debt to equity. Senior creditors receive 84 million cash plus 12 million new shares, 10% of post-reorganization equity. Chapter 7: United States Liquidation. The business ceases operations. A trustee sells assets and distributes proceeds. Secured creditors are paid first, usually 100% of collateral value. Unsecured creditors receive residual, often a few cents on the dollar. Analogy: closing a store and auctioning all its inventory. Creditor committee optimization. Use Pareto principle. 80% of recoveries come from 20% of creditors. Build a priority matrix: Class A secured lenders, bank loans; Class B senior unsecured bondholders; Class C sub-senior mezzanine and equity. The committee's composition influences the plan's concessions. For example, giving senior creditors a cash-in-kind instrument, payable in cash or future equity, can preserve cash for operations while still offering value. Shareholder dilution arithmetic. Suppose post-reorganization equity is projected at 100 million shares. Existing shareholders hold 30 million shares, 30%. The plan creates 20 million new shares for debt-to-equity conversion. New total equals 120 million shares. Existing shareholders' stake equals 30 million divided by 120 million, 25%, which translates to 5% dilution. Dilution percent equals new shares divided by old shares plus new shares, 20 divided by 120, which is 16.7% of the total pool, but each original holder loses 5% of ownership. Negotiation tips. 1. Prepare a realistic cash flow forecast. Shows why full payment is impossible. 2. Propose a super priority tranche, for example, 5% of cash flow for the first 12 months, to satisfy the most senior creditors. 3. Use bootstrap equity. Let insiders inject modest capital for a small equity bump, signaling confidence. Takeaway: understanding the legal path, Chapter 11 verses 7, structuring creditor committees and calculating dilution are essential to obtain a workable reorganization plan that balances the rights of all parties. 5. Cash flow management and working capital optimization. Goal: ensure the firm can meet day-to-day obligations and fund the turnaround without constantly seeking external financing. Cash conversion cycle (CCC). Formula: CCC equals DSO plus DIO minus DPO. DSO, days sales outstanding, equals accounts receivable divided by revenue times 365. DIO, days inventory outstanding, equals inventory divided by COGS times 365. DPO, days payables outstanding, equals accounts payable divided by COGS times 365. Example: pre-turnaround. Revenue equals $500 million. Cost of goods sold equals $300 million. Accounts receivable equals $80 million. Inventory equals $50 million. Accounts payable equals $40 million. DSO equals 80 divided by 500 times 365, equals 58.4 days. DIO equals 50 divided by 300 times 365 equals 60.8 days. DPO equals 40 divided by 300 times 365 equals 48.7 days. CCC equals 58.4 plus 60.8 minus 48.7 equals 70.5 days. Cash is tied up for greater than 2 months. Turnaround actions. Tighten credit, reduce DSO to 45 days. Adopt just-in-time, lower DIO to 30 days. Negotiate better terms, raise DPO to 60 days. New CCC equals 45 plus 30 minus 60 equals 15 days, freeing up cash of approximately 15 divided by 365 times, revenue approximately $20.5 million. Net working capital NWC forecasting. NWC equals current assets minus current liabilities. Build a month-by-month spreadsheet projecting accounts receivable, inventory, and accounts payable based on sales growth assumptions. Sensitivity, vary DSO by plus or minus 10% and observe NWC impact. If sales rise 5% to $525 million while DSO stays at 45 days, accounts receivable equals 45 divided by 365 times 525 equals $64.7 million, down from $80 million. NWC improves. Liquidity ratios. Current ratio equals current assets divided by current liabilities. Target greater than 1.2 for stability. Quick ratio equals cash plus accounts receivable divided by current liabilities. Goal greater than 0.8. After the CCC improvements, assume cash rises to $30 million, accounts receivable $65 million, inventory $40 million, accounts payable $70 million. Current assets equals 30 plus 65 plus 40 equals $135 million. Current liabilities equals $70 million. Current ratio equals 1.93. Quick ratio equals 30 plus 65 divided by 70 equals 1.36, both healthy. Sensitivity analysis spreadsheet style. Variable base case plus 10% minus 10%. DSO days 45, 49.5, 40.5. DIO days 30, 33, 27. DPO days 60, 66, 54. CCC days 15, 18.5, 13.5. Cash freed $1 million 20.5, 15.8, 24.3. This table shows how a modest deterioration in collection or inventory can quickly erode cash. Takeaway: by quantifying the CCC, forecasting NWC, and performing sensitivity checks, managers can pinpoint the biggest cash drainers and prioritize actions that free up liquidity for the turnaround. Economic value added, abbreviation EVA. Formula: EVA equals NOPAT minus invested capital times WACC. NOPAT stands for net operating profit after taxes. Example: year 1 post-reorganization. Earnings before interest and taxes equals $25 million. Tax rate equals 30%. Therefore, NOPAT equals $25 million times open parenthesis 1 minus 0.30 close parenthesis equals $17.5 million. Invested capital equals $120 million, which is assets minus non-interest-bearing liabilities. Weighted average cost of capital equals 10%, therefore capital charge equals $12 million. EVA equals $17.5 million minus $12 million equals $5.5 million, which is positive and indicates value creation. Return on invested capital, abbreviation ROIC. Formula: ROIC equals NOPAT divided by invested capital. Using the same numbers, ROIC equals $17.5 million divided by $120 million equals 14.6%. Compared to weighted average cost of capital 10%, ROIC is greater than WACC, therefore it creates shareholder value. Altman Z-score bankruptcy risk. For public manufacturing firms, Z equals 1.2 times X sub 1 plus 1.4 times X sub 2 plus 3.3 times X sub 3 plus 0.6 times x sub 4 plus 1.0 times x sub 5. x1 equals working capital divided by total assets. x2 equals retained earnings divided by total assets. x3 equals earnings before interest and taxes divided by total assets. x4 equals market value of equity divided by book value of total liabilities. x5 equals sales divided by total assets. Assume after restructuring, working capital equals $20 million, total assets equals $200 million, retained earnings equals $40 million, earnings before interest and taxes equals $25 million, market value of equity equals $150 million, book value of liabilities equals $80 million, and sales equals $300 million. x1 equals 0.10, x2 equals 0.20, x3 equals 0.125, x4 equals 1.875, x5 equals 1.5. Z equals 1.2 times 0.10 plus 1.4 times 0.20 plus 3.3 times 0.125 plus 0.6 times 1.875 plus 1.0 times 1.5 equals 0.12 plus 0.28 plus 0.4125 plus 1.125 plus 1.5 equals 3.44. A z-score greater than 2.99 indicates a low probability of bankruptcy, which is a positive sign. KPI dashboard design. Columns are KPI, formula or target, frequency, and reason for monitoring. Cash conversion cycle in days equals days sales outstanding plus days inventory outstanding minus days payable outstanding, measured monthly, to monitor liquidity health. EBITDA margin equals EBITDA divided by revenue, measured quarterly, to monitor operating efficiency. Debt over EBITDA equals total debt divided by EBITDA, measured quarterly to monitor leverage risk. ROIC versus WACC equals ROIC minus WACC, measured annually to monitor value creation. Customer retention rate equals customers at end of period minus new customers divided by customers at start, measured monthly to monitor revenue stability. Employee productivity equals revenue per employee, measured quarterly to monitor cost control. Thresholds set red, amber, green bands. For example, cash conversion cycle less than 20 days is green, 20 to 45 days is amber, greater than 45 days is red. Takeaway: combining EVA, ROIC, Altman Z-score, and a concise KPI dashboard gives the board a clear numbers-driven picture of whether the restructuring is paying off and where corrective actions may still be needed. 7. Legal, tax, and regulatory considerations in restructuring. Goal: navigate statutes, minimize tax leakage, and avoid regulatory pitfalls that could undo the financial work. Insolvency law nuances. U.S. Bankruptcy Code, Chapter 11 Reorganization versus Chapter 7 Liquidation. Key difference: 11 preserves the entity, 7 dissolves it. EU Insolvency Directive requires a creditor in possession, CIP, or debtor in possession, DIP, process, similar to Chapter 11, but with a stricter early warning trigger balance sheet test. Cross-border restructuring. The UNCITRAL model law allows a primary proceeding in the home jurisdiction and secondary proceedings elsewhere, coordinating asset freezes and creditor ranks. Tax impact of debt equity swaps. Interest deductibility. In many jurisdictions, interest expense is limited to a percentage of EBITDA. For example, 30% in the US under Section 163J. Example: after swap interest equals $6 million, EBITDA equals $25 million, interest percent 24%, fully deductible. Equity-based compensation, converting debt to preferred shares may create constructive dividend treatment. If the preferred dividend rate is 5% on $30 million, the tax authority may deem $1.5 million as dividend, taxed at the corporate level. Capital gains versus ordinary income. Creditors receiving shares may recognize capital gain or loss. Structuring a tax-free reorganization IRC Section 36801 can defer recognition if the transaction meets continuity of interest tests greater than 40% equity held by original shareholders after the swap. Statutory rate calculations. Withholding tax on cross-border interest. Suppose the firm owes foreign lenders $10 million interest. Home country rate 10%, treaty reduces to 5%. Withholding equals $10 million times 5% equals $0.5 million. Saved $0.5 million. Stamp duty on share issuance. Many countries levy 0.5% on the market value of newly issued shares. New equity issued equals $30 million. Stamp duty equals $30 million times 0.5% equals $0.15 million. Regulatory approvals. Antitrust clearance. If the turnaround involves divesting a business to a competitor, the Hart-Scott-Rodino filing U.S. may be required, with a 30-day waiting period. Sector-specific licenses. Financial institutions must obtain Fed regulatory consent for major capital structure changes. Failure can delay the plan. Practical checklist. 1. Map all jurisdictions and identify governing insolvency statutes. 2. Quantify tax benefit of interest versus equity, deductibility limits, treaty rates. 3. Prepare documentation for continuity of interest to qualify for a tax-free reorganization. 4. Engage counsel early for antitrust and sector license filings. 5. Build a tax impact waterfall pre- and post-restructuring to present to the creditor committee. Takeaway: legal and tax considerations are not peripheral. They directly affect cash flow, the feasibility of debt-equity swaps, and the speed at which a reorganization can be executed. A solid compliance framework prevents costly delays and unexpected tax liabilities. 1. Cash conversion cycle. Revenue equals $500 million. Cost of goods sold approximately 85% of revenue, typical manufacturing. Therefore, cost of goods sold equals $425 million. Days sales outstanding equals 60 divided by 365 times $500 million, which is $82.2 million accounts receivable. Therefore, days sales outstanding in days equals 60. Days inventory outstanding equals 70 divided by 365 times $425 million, which is $81.5 million inventory. Therefore, days inventory outstanding in days equals 70. Days payable outstanding equals 45 divided by 365 times $425 million, which is $52.4 million accounts payable. Therefore, days payable outstanding in days equals 45. Cash conversion cycle equals 60 plus 70 minus 45, which is 85 days. Cash tied up approximately equals 85 divided by 365 times $500 million, which is $116.4 million. 2. Debt reprofilings. Original senior debt $200 million at 8%, therefore interest equals $16 million. New terms 10-year maturity at 6%, therefore interest equals $12 million. Annual principal amortization straight line equals $200 million divided by 10, which is $20 million per year. Total annual cash outflow for senior debt equals $12 million plus $20 million, which is $32 million versus $36 million previously. 3. Equity recapitalization. Swap 20% of senior debt equals 0.2 times $200 million, which is $40 million. Share price set at $25, therefore new shares equal $40 million divided by $25, which is 1.6 million shares. Existing equity before swap equals $50 million divided by $25, which is 2 million shares. Post-swap total shares equals 2.0 million plus 1.6 million, which is 3.6 million. Existing shareholders' ownership equals 2.0 divided by 3.6, which is 55.6%, down from 100%. Dilution equals 44.4% of ownership transferred to former creditors. 4. APV valuation. Unlevered value present value of unlevered free cash flow equals the sum from T equals 1 to 5 of 30 divided by 1.09 to the power of T, which equals $115.1 million. Terminal value equals 30 times 1.02 divided by 0.09 minus 0.02, which equals $442.9 million. Present value of terminal value, discounted 5 years equals $442.9 million divided by 1.09 to the power of 5, which is $286.3 million. Unlevered firm value equals $115.1 million plus $286.3 million, which is $401.4 million. Tax shield, new senior debt $200 million at 6%, therefore interest $12 million. Tax shield equals $12 million times 30%, which is $3.6 million per year. Present value of shield assuming a perpetuity discounted at cost of debt 6% equals $3.6 million divided by 0.06, which is $60 million. Adjusted present value equals $401.4 million plus $60 million, which is $461.4 million. 5. Post-turnaround Altman Z-score. Updated numbers. Total assets approximately $500 million unchanged. Working capital $15 million, retained earnings $20 million, earnings before interest and taxes post-turnaround 8% of $500 million equals $40 million. Market value equity $80 million, book liabilities $250 million, sales $500 million. X1 equals 15, divided by 500 equals 0.03. X2 equals 20 divided by 500 equals 0.04. X3 equals 40 divided by 500 equals 0.08. X4 equals 80 divided by 250 equals 0.32. X5 equals 500 divided by 500 equals 1.0. Z equals 1.2 times 0.03 plus 1.4 times 0.04 plus 3.3 times 0.08 plus 0.6 times 0.32 plus 1.0 times 1.0, which equals 0.036 plus 0.056 plus 0.264 plus 0.192 plus 1.0, which equals 1.55. Although lower than before, the score reflects higher leverage after the swap. The firm must continue to improve profitability to push Z above 2.9. 6. KPI dashboard. Cash conversion cycle in days. Target green 30 days or less, amber 31 to 60 days, red greater than 60 days. Calculated as days sales outstanding plus days inventory outstanding minus days payable outstanding. Debt over EBITDA. Target green 3.0 or less, amber 3.1 to 4.5, red greater than 4.5. Calculated as total debt divided by EBITDA. Return on invested capital. Target green 12% or higher, amber 8 to 11%, red less than 8. Calculated as net operating profit after tax divided by invested capital. EBITDA margin. Target green 10% or higher, amber 7 to 9%, red less than 7. Calculated as EBITDA divided by revenue. 7. Legal route recommendation. Chapter 11 is preferred because going concern value, the firm still generates cash, earnings before interest, taxes, depreciation, and amortization approximately $40 million, and can fund a reorganization plan preserving jobs and the brand. Automatic stay protects the firm from creditor lawsuits, while negotiations on the debt swap and equity issuance occur. Statutory considerations. Section 363 allows the company to sell non-core assets free and clear of liens, essential for the planned divestiture of an underperforming line. Section 1125 mandates fair and equitable treatment of each creditor class, guiding the 20% debt